Now, you end up, whether it's in a formal or really an informal sense, advising a lot of investors and prospective investors. So, just talk to us about what your investment criteria looks like through your lens when you're talking to these investors.
Yeah, and I've had the blessing to own over 300 rental properties myself and help thousands of clients build their portfolios. So I can speak from experience here. And the things that I look at and that I advise my clients to look at is number one, you have to invest in a market where the assets pay for themselves. That is the entry into this game,
Yeah.
right? We do not want to invest in assets that do not pay for themselves every single month, because then you are speculative. You're hoping on home price appreciation to bail you out at some point. And that doesn't play. That doesn't play for me and for our investors. So number one, you have to invest in an asset, in a market where they have assets that pay for themselves every single month. What you also need to look at, the second point would be, you need to invest in a market that has a strong economic basis. And the thing that I look at to evaluate that is that they have over 1 million people there. If you invest in a market with less than 1 million people, you run the risk of there just not being a huge housing demand. But more importantly, you run the risk of one or two companies really changing the landscape of the investment in that area. If one or two companies should leave, that might take a tremendous amount of your renting or buying pool away from the real estate market. Never a good thing there.
When you have
Um,
over 1 million residents, you have significant ballast, and you're almost certainly going to have substantially diverse economic sectors versus investing in the tertiary town that has 21,000 people, where 40% of their employment is based on one factory or one industry.
Absolutely. The way you lose in rental properties is if all of your people stop renting. So if all of the jobs leave because a company leaves like that, that's a recipe for disaster. So you mitigate that risk by investing in those types of markets that you mentioned, those markets that have over 1 million people. So
And
I've got a
then,
couple more for you too, Keith, that really matter to me as far as the investment criteria. Should we go there?
yeah, talk to us about that, Greg.
Okay. So in my mind, that's the barrier for entry, right? Over 1 million people, and you have positive cash flow. It pays for itself every single month. But at that point, that's where I think clients and investors need to take that additional step that most investors don't do. And that's where you need to look at some of these short-term and long-term indicators for home price appreciation. Again, my mentality here is, you're an investor who's planning on holding on for 20 years, 30 years. If you're not, then home price appreciation shouldn't matter to you, right? But if you are, you should start to look to these factors. So the next thing that you should pay attention to is population growth. In markets where population is growing, it should make sense to everybody that there's an increased housing demand. The next thing to look at is the markets that historically have a larger home price appreciation rate. And again, as I'm speaking to investors that are in for the long haul, over 20 years or longer, that's where you get your historical home price appreciation rate. The theory here, and what's been proven over and over and over again, is that if you give yourself a 10-year, 20-year cycle, the market, the region that you're investing in, is going to come back to the norm. And at that point, you can really bank on home price appreciation. So I think it comes down to those four factors, Keith.
Yeah.
Positive cash flow pays for itself, million residents, population growth in the market, and look for the ones that have the highest percentage of population growth and the highest percentage of home price appreciation over the long haul.